Norway's sovereign wealth fund, the largest on the planet at $2.1 trillion, just told the world that markets are still underpricing the risk of everything falling apart at once. This is the Situation Room, March 19, 2026. Here's what you need to know. The Fed held, but the math changed. Yesterday, the Federal Reserve voted 11-1 to hold interest rates at 3.5 to 3.75%. On the surface, that sounds boring. A hold is a hold. But inside that decision was a dramatic revision. The Fed raised its 2026 inflation forecast to 2.7% and cut expected rate cuts for the year from 2 down to 1. 7 of the 19 FOMC participants now expect rates to stay unchanged through all of 2026. Markets responded immediately. The Dow dropped 768 points. The S&P fell 1.35%. The Nasdaq shed 1.46%. The VIX, which measures fear, jumped 12% in a single session to 25. The Fed isn't just pausing, it's quietly reversing the narrative. For the past 18 months, the entire market has been pricing in an easing cycle. Falling rates, looser credit, cheaper capital. That consensus is now cracking. The Fed cited Iran war uncertainty explicitly in its statement. When a central bank raises an inflation forecast mid-conflict, it's not hedging, it's warning. And globally, it gets worse. The ECB is now pricing in rate hikes this year. The Bank of England faces a 60% probability of a rate increase, and the Bank of Japan is holding firm, citing upside inflation risks. The synchronized global easing narrative is dead. Real estate is the most direct casualty. Morningstar already flagged fundamentals declining again in 2026, and a rate hold removes the one catalyst the sector was counting on. The REIT sell-off is structural, not cyclical. For consumer discretionary, which dropped over 3% on March 18 alone, this is a double hit. Tighter money plus an oil-driven inflation shock compressing the purchasing power of every American household. The beneficiaries are fewer. Utilities, now re-rated as a growth sector rather than a defensive one, on the back of AI data center electricity demand, continues to look resilient. Energy obviously wins when oil prices spike. Brent briefly touched $126 and is settling near $120, but almost everyone else is absorbing pain. Trump threatens to destroy the world's largest gas field. This morning, President Trump issued a public warning that the United States could destroy Iran's South Pars gas field if Qatar is attacked. South Pars is not a minor target. It's one of the largest natural gas fields on the planet, and it supplies a significant portion of European LNG imports. This follows a UAE-confirmed drone strike on the Shah gas field and a tanker hit near Fujairah in the Gulf of Oman. The Strait of Hormuz, the choke point through which 20% of global oil passes, is now a live disruption risk. Crude inventories actually rose 6.2 million barrels this week, which in a normal market would push prices down. Instead, Brent hit $126, and WTI breached $115. Supply fear is overriding supply reality. U.S. gas prices just hit a 3-year high. The energy infrastructure of the Middle East is no longer theoretical collateral damage in a regional conflict. It is the primary battleground. The IEA governing board held an emergency meeting on oil market stability. That's not a routine event. When emergency meetings happen, it means the people who manage global energy reserves are worried about running out of tools. For businesses, if your supply chain touches pharmaceuticals, critical minerals, LNG, or general cargo through the Gulf, your costs are rising now, not eventually. Shipping routes are being rerouted through longer, higher-cost paths. 86% of industry leaders in a March survey reported tariff-driven supply chain disruption. 51% have already raised prices. That's up from 31% a year ago, a 65% jump in pricing pressure in 12 months. Layer Iran war logistics disruption on top of that, and you have a compounding cost shock that isn't theoretical. Here's what most people are missing. Story 1 and Story 2 are not separate events. They are the same feedback loop running in two directions simultaneously. The Iran war sends oil to 120-point dollars push different. Oil at $120 box pushes inflation. Inflation forces the Fed to abandon its easing cycle. The Fed abandoning easing means capital stays expensive. Expensive capital crushes real estate and consumer discretionary. Crushed consumer sectors lay off workers. Amazon and Meta eliminated 30 roles in Q1 2026 alone. Less employed consumers spend less. Less spending slows growth. Slower growth in a high-rate environment is stagflation. And here's the part that makes Norway's sovereign wealth fund nervous enough to say it publicly. Markets are still underpriced for this outcome. The ECB's own supervisory report said geopolitical risks are underpriced. The S&P closed at 624 on March 18th. That's not a market pricing in stagflation. That's a market still hoping this resolves quickly. Meanwhile, Nvidia revealed over $1 trillion in expected chip orders through 2027 at GTC. AI infrastructure spending continues accelerating even as the geopolitical environment tightens around it. The convergence risk is real. An AI investment supercycle running at full speed into a stagflationary macro environment, with energy prices threatening the very data center electricity demand that is underwriting utilities' sudden growth story. This is not one domino. It's a chain reaction still in its early stages. If you run a business in manufacturing, logistics, or anything touching physical goods, your